Hey everyone, welcome back to Corporate Decoder. Today, Howard Hughes Holdings Inc. just completed a major acquisition, and I'm seeing some interesting new financing that changes everything. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is buying another company for over $2 billion. And the way they are paying for it involves some big names and new kinds of stock. Alright, let's dive into Howard Hughes Holdings Inc.'s latest report, which tells us about a huge deal they just wrapped up. This is essentially a Form 8K, so it is reporting a big event that just happened. The main event we are talking about here happened on the 4th of June, 2026. This is all about Howard Hughes Holdings Inc., which you might know for its real estate development. They are a pretty significant player in that space. They are incorporated in Delaware, which is common for big companies, and their stock is traded on the New York Stock Exchange under the ticker symbol HH. The big news here is that Howard Hughes Holdings Inc., through a subsidiary called Howard Hughes Insurance Holdings, has bought a company named Vantage Group Holdings. Limited, this acquisition cost them a cool $2.1 billion. This wasn't a small deal, and it involved a lot of players, including investment firms like Carlyle Partners and H&F. The agreement to buy Vantage was actually signed way back in December of 2025. And now, on the 4th of June 2026, they've officially closed the deal. They paid $2.1 billion in cash for all of Vantage's stock. Now, Vantage is an insurance company, specifically a re-insurer. This means Howard Hughes Holdings is moving into the insurance business, which is a pretty big strategic shift for a real estate developer. This makes them a more diversified holding company, which is something you often see as companies mature and look for new growth avenues outside their core business. So, how did they pay for this massive acquisition? They used some of their own cash, but a big chunk, $1 billion, came from something called preferred equity financing. And the investor here is a well-known name, Pershing Square Holdings LP, which is an investment fund run by Bill Ackman. Pershing Square is already a major shareholder in Howard Hughes Holdings, owning over 31% of the company. So this is a significant investment from a key partner. It is interesting to note that a special committee of the company's board, made up of independent directors, reviewed and approved this financing. This is a good sign for good governance, especially since Pershing Square is already such a large shareholder. They wanted to make sure this deal was fair and in the best interest of the company. As part of this financing, Howard Hughes Holdings entered into a subscription agreement, or SA, with Pershing Square. What they did was issue $1 billion worth of a new type of stock to Pershing Square. This is called Series and Non-Voting Exchangeable Perpetual Preferred Stock. Let's break that down. It is preferred stock, which usually ranks higher than common stock. It is non-voting, so Pershing Square doesn't get a say in day-to-day company decisions through this stock. It is exchangeable, meaning under certain conditions it can be converted into something else, which we will get to. And it is perpetual, meaning it doesn't have a fixed maturity date. Preferred means it has certain advantages over common stock, like a preference in receiving dividends or assets if the company liquidates. One key part of this agreement is that Pershing Square has a right of first refusal. This means if Howard Hughes Holdings or its subsidiary ever wants to sell more of the subsidiary's equity to another company, Pershing Square gets the first chance to buy it on the same terms. This gives them a way to maintain or increase their stake. The details of this new preferred stock are laid out in a document called the Certificate of Designations. This preferred stock ranks equally with the company's common stock. This is not always the case with preferred stock, so it is worth noting that it is on par with common shares. Regarding dividends, the board can declare them on this preferred stock, but only if the company receives those dividends from Vantage, the acquired insurance business. So the dividends on this preferred stock are directly tied to the performance and cash flow of the new insurance operations. Now, about that exchangeable part, within a certain time frame after the original issue date, and then each year after that, holders of this preferred stock, like Pershing Square, can exchange it for common equity interests in the subsidiary that bought Vantage. This is essentially how Pershing Square can eventually convert its preferred financing into actual ownership of the insurance business. The formula for how much of the buyer's units they get is based on the money they put in, plus any dividends they missed out on by not already owning the buyer's units, minus any dividends they did receive. And there is an ownership cap, meaning Pershing Square cannot end up owning more than 49% of the subsidiary's units without special approval. This is a way to limit their control, while still allowing them to convert their investment into equity. Howard Hughes Holdings also has a call option. This means at certain times they can choose to buy back this preferred stock from Pershing Square. The price would be based on either the original investment plus interest, or a multiple of the subsidiary's book value, whichever is higher. This gives the company flexibility to retire this financing down the road. There are also conditions that would force the company to buy back the preferred stock. These include things like a change of control of the company or the subsidiary, or a sale of substantially all of their assets, with some exceptions for transactions involving Pershing Square itself. If the company fails to repurchase the stock when required, it gets a hefty penalty. A 10% dividend on the original issue price annually, called the defaulted repurchase dividend rate. They also can't pay dividends on junior securities during this time, effectively prioritizing paying back this preferred stock. The preferred stock also has protective provisions. This means that for certain major decisions, like issuing more equity in the subsidiary or making changes that could negatively affect the preferred stockholders, a majority of the preferred stockholders' consent is needed. Finally, there is a registration rights agreement, or RR. This basically outlines how the shares held by Pershing Square, especially after they might exchange their preferred stock for equity in the subsidiary, can be registered and sold to the public. It gives Pershing Square the ability to demand that the company help them go public or sell their shares. So to recap, the acquisition of Vantage is complete, making Howard Hughes Holdings a more diversified company. And the $1 billion preferred stock issuance to Pershing Square happened under an exemption from registration, meaning it was not publicly offered to everyone, but directly to Pershing Square. The company also issued a press release on the 4th of June, announcing the closing of the acquisition. They've also listed all the relevant exhibits, including the purchase agreement, the subscription agreement for the preferred stock, and the registration rights agreement. They will file the detailed financial statements for Vantage in an amendment later. And the report is signed off by David O'Reilly, the Chief Executive Officer. Now, looking at the bigger picture here, Howard Hughes Holdings is making a bold move into the insurance sector. This acquisition significantly diversifies their business beyond real estate. The $1 billion investment from Pershing Square is crucial. It is not just debt financing, it is structured as preferred equity, which has different implications for their balance sheet and future capital structure. The terms of this preferred stock, allowing for exchange into equity of the acquired insurance business and giving Pershing Square rights and protections, suggest a well-structured partnership. The risk I am watching is how well Howard Hughes Holdings can integrate and manage an insurance operation, which is a completely different business from real estate development. The success of this diversification will hinge on their ability to extract value from Vantage while managing the obligations and rights associated with Pershing Square's investment. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.